We're going to delve deeper into what the stress tests mean for Europe's economy with HSBC's chief economist. He joins me now, Stephen King.
Hello.
Thank you so much for coming in to speak to us. So, in your latest article, you say that Western economies have hit a brick wall. What exactly do you mean by that?
Well, they borrowed too much over many, many years. There's far too much debt in the Western world. We had debt, first of all, in the financial system and debts for households. And now, of course, we've got huge amounts of debts coming through for governments. So we've kind of been living beyond our means for a number of years. And we now have to effectively face the consequences of that, which is going to be many years of austerity, unfortunately.
Talk to me about European banks, because when we speak about debt and sovereign debt, these banks are, of course, being tested to see how they would fare in the event of a sovereign default. How concerned are investors about the ability of European banks to refinance themselves, and indeed the extent to which they are relying on loans from the European Central Bank?
Well, funnily enough, I think the issue at the moment is not so much whether the individual commercial banks are in trouble or not in trouble, but rather if they were to be in trouble, what would happen next? And what are the sort of depths of pockets that governments have to bail them out? Because one of the big differences now compared with 3 or 4 years ago is that governments' budget deficits are far, far bigger. So the extent to which banks could be supported if there were to be another failure coming through would be much smaller than was the case in the past.
Well, are governments really in a position to be injecting more cash into banks when they are dealing with their own massive mounting budget deficits?
Well, the alternative, of course, would be rather than to have governments injecting money into banks, to sell the banks off to other investors. And, of course, the deep pockets around the world come through from the emerging nations, whether it's China or Saudi Arabia or others. So you could find that some banks eventually find themselves being bought by those foreign governments or foreign investors at some point in the future. But as far as the governments in the West are concerned, there's no doubt that the fiscal positions are now extremely weak. There's now a political consensus, certainly in Europe, to say that we should have austerity rather than further fiscal expansion. Different view, of course, in the US, but at the moment a desire to have lower rather than higher budget deficits in the future.
Why is this happening, Stephen? We've had massive stimulus measures on both sides of the Atlantic. Central banks have been printing money, quantitative easing, interest rates are low, indications are they're going to remain low. Why isn't this working?
Well, in one sense it has worked, because the worst possible outcome would have been a Great Depression Mark II, a complete collapse in economic activity, and we haven't had that. We've had a stagnation, a deep recession, but not the complete collapse we saw in the 1930s. So in one sense, compared with what might have happened, the outcome's not been too bad.
Well, there hasn't been a collapse, but at the same time, the recovery that we were all hoping for hasn't materialised either,
That's
right?
because people's hopes were too high. And the problem here, of course, is that if you borrow too much in the first place, there's a limit to what Keynesian policies can ultimately achieve. You may want to loosen fiscal policy and cut interest rates, but people who have too much debt in the first place are much more interested in deleveraging. It's what I'd call a Japan-light kind of story, whereby having borrowed far too much, there's a limit to what policy can actually achieve.
So what are you saying, that potentially we in the West are facing a lost decade of economic growth as we saw in Japan? What needs to happen for the US and Europe to avoid Japan-style deflation?
Well, the difficulty here is increasing. It's more similar to look at the situation in the West compared with Japan. If you look at Japan over the last few years, we've had very weak money supply growth, remarkably low inflation, very low bond yields, and all these kinds of symptoms we're now beginning to see in the States and in Europe. So despite the fact that policy has been loosened hugely over the course of the last 2 or 3 years, we're actually looking more like Japan now than was the case 3 or 4 years ago, which reflects this fact that debt has become too large. In other parts of the world, the news is much more positive. In the emerging markets, we're seeing increasing emerging market trade to other emerging markets, which is much more helpful than was the case in the past. Very low interest rates in the States and Europe and Japan will help carry trades into the emerging world over the course of the next few years. And commodity prices are much higher, which is supporting emerging market export earnings.
So, thank you very much indeed for joining us. Stephen King, thank you very much indeed, Chief Economist, HSBC. Appreciate your time.